Year after year, this client was overpaying about $61,000 in taxes. Not because of fraud, not because of aggressive positions. Everything looked fine. The return was filed, income was reported, taxes were paid. Nothing flagged, nothing questioned. 5 years? That's over $300,000 gone. 10 years? You're looking at $600,000 plus lost. And none of it came from doing something wrong. It came from what wasn't being done.
So no mistakes, just no strategy?
Exactly. No one was doing real tax planning. And when there's no planning, overpayment becomes the default. Welcome to Ivy Smart Tax. This is a tax leak case. Here's the setup. Married couple, 2 kids. Total income about $1.32 million. Income mix. W-2 salary, about $420,000. S-Corp construction management firm, about $760,000 profit. Some investment income.
So they're already doing pretty well.
Yes, multiple income streams. Active business, strong earnings. This isn't a starting point. It's already a developed financial structure.
So the issue isn't income.
Exactly. The issue is how that income is being handled. Everything was being treated as tax preparation, not tax planning.
So they're filing correctly but not strategically?
Exactly. And this is exactly what we see all the time. People overpay taxes not because something is wrong, but because something is missing. They're not using proactive strategies, or they're getting advice that only covers part of the picture.
So it's not always wrong, just incomplete?
Exactly. The numbers can be accurate, the return can be clean, but if the planning isn't there, the outcome won't be efficient.
So compliance handles the past?
And planning shapes the result. Compliance tells you what you owe. Planning changes what you owe. This client had a business, a full team of employees, and strong, consistent profit. From the outside, everything looked successful, but there was no coordinated strategy behind it. Each part existed, but nothing was working together to shape the tax outcome.
So they had all the pieces but no overall plan?
Exactly. Which means every year they didn't direct the outcome, they just accepted it.
So they weren't doing anything wrong.
They just weren't doing anything strategic. And when there's no strategy, the tax result defaults to whatever the system produces. First strategy, fix S-Corp salary structure. They were paying themselves about $90,000 in salary on over $700,000 in profit.
Sounds like they were trying to minimize payroll tax.
Yes, but it may not have been properly structured based on the facts, because at that level, the salary doesn't reflect the actual value of their role in the business. From the IRS perspective, that gap may raise IRS scrutiny, depending on the facts. And from a tax perspective, it creates imbalance in how income is treated.
So it's not just about lowering salary, it has to match reality?
Exactly. Too low creates risk. Too high creates unnecessary tax. The goal is to find the correct range. We recalibrated the salary to about $220,000, a more supportable level based on available data. That adjustment aligns with the role, the responsibilities, and the profit of the business. Result: better audit position, optimized balance between payroll and distributions, approximately $28,000 estimated annual tax savings.
Same business, different structure?
Exactly. Nothing about the operations changed, only how the income was structured. And once that structure aligned with reality, the tax outcome adjusted with it. Next, missed business deductions. We found no accountable plan, no structured reimbursement system, and multiple expenses sitting on the personal return.
So they had deductions, just in the wrong place?
Exactly. The spending existed, but it wasn't being captured at the business level. which means it may not have been reducing income in the most efficient way.
So even though they were deducting, they weren't getting the full benefit?
Exactly. Because in tax planning, it's not just about whether something is deductible, it's about where that deduction shows up. We implemented a structured reimbursement system, an accountable plan, home office allocation, vehicle and administrative expense restructuring.
So now those expenses move through the business?
Exactly. Instead of sitting on the personal return, they're now captured at the entity level, which means they reduce the right income in the right place. Approximately $9,000 to $12,000 estimated annual tax savings. Next, retirement strategy. They were contributing, but without coordination. Some years higher, some years lower, no clear structure behind the contributions.
So they were saving, just not strategically?
Exactly. We introduced a structured approach, optimized salary deferral, employer contribution layering. So each piece works together, not randomly.
So this isn't about putting in more, it's about placing it correctly?
Exactly. Because retirement contributions don't just reduce tax, they need to align with the overall income structure. Result? Approximately $11,000 estimated annual tax savings, plus long term growth inside the structure.
So it's not just saving tax now,
No, it's controlling when that tax shows up. Instead of recognizing all income today, you're shifting part of it into a different timeline.
so the benefit isn't just the amount, it's the timing?
Exactly, because in tax planning, timing is leverage. Now, here's a big one. Even after the year ended, there were still opportunities. This is what most people miss. They assume once December closes, everything is locked.
Wait, you can still save tax after the year ends?
Yes, because not everything is based on cash movement. Some strategies depend on elections, classifications, how items are reported.
So the numbers are the same, but the treatment can still change?
Exactly. The IRS doesn't just look at what happened, it looks at how it's characterized. And that window doesn't always close on December 31st. We implemented targeted post year adjustments, retirement timing corrections, expense classification updates.
So this wasn't new spending, just correcting how things were handled?
Exactly. Nothing changed about the activity itself, only how it was positioned on the return. And that shift created immediate impact. Approximately $6,000 estimated tax saving.
So even after the year ends, there's still room to improve the outcome?
Exactly. Because in some cases, it's not too late, it's just not reviewed yet. Next, income positioning. They were taking income as it came, no timing strategy behind it, which means income was being recognized without considering its tax impact.
So the issue isn't earning, it's when it shows up?
Exactly. We evaluated timing of distributions and income recognition where permissible under tax rules.
So now income is aligned with the rest of the plan?
Yes, because income timing affects everything else: tax brackets, deduction availability, phase outs. And when it's uncoordinated, you lose control of all three. Result? Approximately $8,000 estimated annual tax improvement.
Same income, just timed differently?
Exactly. Nothing changed about how much was earned, only when it was recognized. And that shift changed how the income interacted with the rest of the return.
So timing affects more than just cash flow?
Yes, it affects tax brackets, deduction limits, eligibility thresholds, and once those shift, the outcome changes with it. Final issue: everything they were doing was reactive, answering questions as they came up, filing based on what already happened.
So they only planned when something came up?
Exactly. No forward strategy, no coordination across decisions, just responses.
That sounds normal though.
It is. And that's why it's expensive. Because reactive planning always happens after the tax impact is already created. At that point, you're not controlling the outcome, you're just explaining it. We shifted them to proactive yearly planning. Not once a year, not at filing, but throughout the year.
So planning becomes ongoing?
Exactly. Each decision is made with the tax impact in mind, not after. That's where consistency comes from, because the structure is being adjusted in real time, not after the fact. Now, combine everything: $28,000 from structure, $11,000 from retirement, $10,000 from deductions, $8,000 from timing, $6,000 from after the fact adjustments, approximately $60,000 plus estimated annual tax savings.
So no single trick.
No, no one move created this result. It's the coordination, how each piece connects to the others.
So each strategy adds, but also supports the others?
Exactly. That's what real planning looks like. Not isolated decisions, but a system working together. Tax outcomes depend on individual facts, income levels, and proper implementation. Now, the real question: how many years has this been happening? Because this isn't a one time loss, it repeats year after year.
Yeah, that hurts.
Exactly. Because once you see the pattern, you realize how much has already compounded. The good news: once you see it, you can fix it. And once it's fixed, that leak stops.
So the key is just seeing it early?
Exactly. Follow Ivy Smart Tax. I'll show you where your money is leaking.